Hey there, tax fans. Welcome to State Tax Talks with me, your host, Joe Tantillo. I'm a tax attorney at the Hodgson Russ Law Firm looking to explore the nuances of state and local tax law. Here on the show, our goal is to keep tax informative, simple, and fun. So if you're ready to talk tax, turn up the volume and dive into this episode of State Tax Talks. Ladies and gentlemen, welcome to State Tax Talks with Joe Tantillo. Today we're continuing our interview with Mr. Mark Klein and Paul Comeau and our discussion about the history of the state and local tax practice. You know, it sounds like there's a lot of situations where taxpayers can unintentionally shoot themselves in the foot when they don't take the proper planning steps before they actually make these moves. And, you know, that's something that we do here at the firm is we assist not only in the audit dispute controversy resolution process, but, you know, now we do planning as well for taxpayers in residency situations and, you know, sales tax planning as well. When did we make that jump from, you know, we're getting everything at the end and we're constantly fighting these battles because people haven't necessarily taken the steps that they should have to make these an easy win, to, you know, we can really do a lot of good for people, helping them plan in advance for these types of moves.
Yeah, I think there's a misconception by a lot of folks in government that most taxpayers are trying to cheat. And I don't think that's right. Look, there are exceptions to every rule, and have I come across cheaters? Absolutely. But I do think the majority of our clients are really just trying to do the right thing. And so they see the problems, the hassles that their neighbors are going through. They hear through business about all these intrusive audits. I mean, think about how intrusive it is for an auditor to look at every charge you've made on your charge card for the last 3 years, every check you've written to whatever. We've had a number of cases where people claim to have been on a cruise ship. I don't know if, Paul, you remember this case. We had the client who insisted he was on a cruise ship for 2 weeks, was not in New York. And when we said, well, let's come up with the cruise documentation, he said, oh, they need to see that? Because he was with someone he shouldn't have been with. And he said, you know, I'll pay the tax because it's cheaper than alimony. So, you know, the fact is the way we got into planning is people saying, I don't want to be audited and have to go through this for 3 years. Tell me the rules. As long as I understand the rules, I can follow them. And I think people were sensitized to the fact that it makes more sense to plan ahead than to get clobbered, you know, without really planning. I don't know, Paul, is that your experience as well?
Yes. And similarly, New York has done audits of vendors. They did audits of art dealers, jewelry sellers, and so forth. There were cases where people were going into a jewelry store in New York, buying an expensive piece of jewelry, walking out with it, but the vendor would then mail the empty box to them in New Jersey or in Delaware or some other place, and then not collect sales tax because they would treat it as if they had delivered it to them out of state. And when this came up, there were actually criminal charges against the jewelry stores and so forth, but against some of the individuals. And some of the jewelry stores decided that they would just provide a list of all their clients and all the transactions to the tax department. And so people started getting notices of audits saying, we understand that you purchased this item and you actually took it with you from the store, et cetera. If this isn't the case, you know, prove to us that it was shipped to you and that it was properly not taxable by New York. And if it was shipped to you in New Jersey, prove to us that you paid tax to New Jersey on it, for example. And
I think the ex-president of the Tyco Corporation went to jail, if I'm not mistaken, for something like that.
Something like that, the Tyco case, right? But it basically, in some of those cases, individuals came forward to us and said, we want to pay the tax because, again, it was jewelry for a friend, not for my spouse, or other circumstances that suggested that it would be expedient to just pay the tax and move away. But yes, we've talked a lot about residency audits. We started out really with sales tax types audits, residency audits when they became hot. But over the years, industry groups have been targets. The temporary help industry, floor covering, printing, print ad, mailer industry, universities, museums, limo operators, restaurants, cemeteries, nuclear plants, hydropower, information services, computer software, the whole computer software industry. Some of this was written up in newspapers over the time, newspapers themselves and e-newspapers as to whether an e-newspaper is a paper or is an information service, trucking companies, cigarette vendors, art dealers, a whole variety of tax types, industry types, and so forth that we've represented.
Do you think that comes about, those specific industries that you talked about that are targeted, do you think that's a facet of a policy decision at the state level, or is that because that area of law is just not as well defined, and an auditor recognizes that, there's some gray area here. Why don't we?
I think a number of times we were involved, we were approached by the industry that was looking for guidance. I mean, the printing industry, there's all sorts of stuff that goes into a newspaper, there was in the old days, typesetting and ink and this and that, and the sources that they get for information, the wire services. Do they still have wire services? They don't have wires anymore. So they were looking for guidance. And so, no one taxpayer wanted to foot the bill so that they would get the information that all their competitors would then be able to use. So we would sit down with trade groups, and we'd say, tell us what you want, and we will go to the tax department and see if we can work out guidance for you so that your industry, again, can do the right thing. I was approached once by a national retailer who was giving folks coupons. And the problem is, in New York, there are special rules for coupons. The coupon is supposed to say right on it, this is a manufacturer's coupon, which has one set of rules. This is a store coupon, different set of rules. Well, our client was one of the first ones to come up with the little scan card that you would go to the register. And if you were a member of their, frequent buyers club, you'd get a coupon. Well, there is no coupon that's printed that says, whether it's from the manufacturer. And so we went to the state, and back then a friend of ours, Rob Plattner, who used to be a partner at this firm, was deputy commissioner for tax policy. And he put together, all of his folks, and we worked out a program so that we could correctly handle the situation and not be forced into printing coupons, which at that time were disappearing.
Another example of ambiguity and confusion: candy versus cookies or cooking ingredients. If you're buying flour to make cookies, that's not taxable because that's just a product that you buy that's tax-free. And if you're buying cookies, generally they're not taxable, but if you're buying candy, that's taxable. So a question came up about Twix candy bars. Are they in the cookie section of the store,
They're
or are they
candy-coated cookie.
in the candy section of the store? And
Different
the tax
from the
department,
typical debate of which side is better, the left Twix or the right Twix, of course.
the tax department concluded that if they're in the candy section of the store, they're candy and you have to charge tax. But if you're in the cookie section of the store, and somehow the vendor's supposed to keep track of, I sold this Twix and it was over there. Oh yeah, prove it. How can I prove that? Marshmallows, large and small marshmallows, one of Mark's favorites, but they determined that small marshmallows are cooking ingredients, but large marshmallows are candy.
Obviously.
And ultimately, and then the question was, well, how do you handle this?
And the big issue was, what do you do with those little peeps during Easter? Are those exactly that was a real problem?
And so ultimately, there was a commissioner, and we were successful. The industry was successful in saying, leave marshmallows alone. And so the rule was no marshmallows are taxable. And then, as Mark said, the question came up about Peeps because they're sugar-coated marshmallows. And he said, if it's got a marshmallow in it, it's not taxable. I don't want to hear any more about marshmallows.
One of my favorite cases in that area was we represented a company that sold cookies. And the goal of the client was to get them to your dorm room while they're still hot, because people get the munchies around 1 o'clock in the morning, and they want their cookies to be warm. And in New York, cookies, as Paul said, are not subject to tax, but heated foods are taxable. And so the issue was, why are these cookies hot? If they're hot because they just came out of the oven, that isn't taxable. But if they're hot because you kept them hot and put them in a heated state, then they are taxable. And it was always difficult to try to explain to clients, why are your cookies toasty? And trying to get that conveyed to the tax department was also a lot of fun.
Wow.
By the way, we did get free cookies out of the deal, so it was worthwhile.
Well, that's, a victory in any sense. And it has to be, I imagine that sometimes the frustration you feel at the arbitrary differences in some of the reasons why certain things are taxed and certain things are not taxed, there has to be moments where you just want to, hit your hand against your forehead.
And
say,
it's frustrating
this is insane.
because if the taxpayer, if the seller doesn't do it right, if they guess wrong, they're on the hook. Not only are they on the hook, their business is on the hook, but personally, they could lose their house. You can't discharge sales taxes in bankruptcy. So and by the way, sales tax is not supposed to be a cost to the seller, right? They're supposed to be a conduit. The purchaser is supposed to pay sales tax, give it to the seller, who then sends it on to the state. But if you make the wrong guess, the consequences can be terrible. And so, yeah, that's one of the things that is frustrating about this. Although it's also, I got to tell you, one of the most rewarding cases I ever had was when we were trying to work with a A car dealer had gone out of business, and somebody in the accounting office was being held as what we call a responsible officer. It means that they should have made sure sales tax was correctly reported, even though in this case the guy had the title of accounting, but he really, his boss did everything. He just did nothing. And so he was looking at bankruptcy. And I remember it was 2 weeks before Christmas. We got the decision. We went to mediation and we won. And I called him, and his wife got on the phone in tears saying, "You've saved our family. I can't thank you enough." And it was really rewarding. It means every once in a while we can really do some good.
And occasionally we also have interesting situations for big companies that are being hounded by the tax department for something that they claim is completely inappropriate. I had one situation where the client was being chased for $60,000 in a payment. And they said, we sent it in. No, you didn't send it. And here's what you owe. And here's the interest. And here's the penalties. And here are the other consequences. And I ended up having a meeting with the tax department in Albany with very high level people in the tax department who brought the audit file to this meeting. And I said, my client insists that it was sent to you, if you didn't cash the check or whatever. Anyway, they went through the file and they found an unopened envelope dated years earlier,
Oh, gosh.
containing the check.
Wow.
Case dismissed. But very, very interesting. Some of our cases were very technical, where we had to really study. I had one case that involved trucks that were refrigerated trucks. And New York had a fuel tax, a highway fuel tax. And they said, if you're using fuel to run these compressors, then that's fuel that's being used on the highway as you're driving these trucks, this fleet of trucks, and it's subject to the fuel tax. I investigated what was happening and how they actually operated this cooling mechanism, and it turned out that it was nitrogen that was being released, and the nitrogen causes a cooling effect, and that's what they were using. And I said, last I heard from a chemistry class, nitrogen doesn't burn. Fuel has to be something that is combustible, can burn. Here, it's simply escaping and creating this cooling effect. It's not a fuel, and it's not subject to the fuel tax. And of course, that was quite puzzling, but we happened to have an associate here at the time who had an engineering degree, and I had him go and research it and bring his books, and we went in there and we made our presentation, and ultimately they dropped the assessment.
And then that just shows you, how, again, it's a blank slate. So whether it's if nitrogen is considered a fuel, we've had cases whether the creation of electro power is a tangible piece of property, because if you touch it, you're going to feel it. And actually, we won that case, and they changed the law subsequently.
Well, it was a hydropower case,
Yeah.
and so you've got water falling down, and we argued that, you're taking basically mechanical energy,
Kinetic, yeah.
and kinetic energy, and you're harnessing it, and you're creating something that can then be transmitted through power lines to people's homes so that when you plug in a light, it goes on. And there's clearly a change in what you're doing. You're taking energy that's coming in one form and putting it into another form, harnessing it, and then selling it. And that's manufacturing. No, it's not. Anyway, we won that case, and then New York changed the law to say, no, it's not.
Yeah, we've had that happen a lot. A lot of times we've won cases. We've been, very successful, and the legislature then says, well, never mind. We're making too much money from that. But getting back to food a second.
But generally, our client wins, and we make sure that their change is prospective only, and our
Always.
client gets the benefit of the case we just won.
Always.
Right. That way the state can't take their ball and go home just because they're upset afterwards.
Exactly right. One of my favorite cases was for a local grocery store. They used to bring in bananas, they still do probably, from South America. And the question was whether a banana room where these bananas are gassed is part of the manufacturing process as well. And the state, of course, said that's ridiculous. And we were able to show that without this banana gas, the bananas would have gone from green to black. So we handed them these green bananas, and we said, watch what happens. And sure enough, in a week, the bananas turn black, because if they're not subjected to banana gas, they don't ripen. And so we won that case. And I think I got a free bunch of bananas out of that, which was awful nice. But it just shows you some of the intricacies and weirdness of the tax rules. And again, that's one of the benefits of state and local tax, because I would bet I mean, I'm not 100% sure, but I'll bet there is some federal case somewhere on banana gas because it's used across the country for folks that sell bananas. But in New York, we were the first banana gas case and probably the last.
What a rewarding experience it is, getting to practice an area of the law where you get to learn so much information about such a variety of topics and a distinct number of things. I had asked you both at the beginning if you ever envisioned being a full-time state and local tax attorney, and I'm willing to bet that even if that had crossed your mind, which we've already said it hadn't, that you certainly didn't imagine fighting over the size of marshmallows or the heat level of a cookie or the importance of various gases in keeping bananas ripe. I mean, what a fascinating career area to not only practice, but really you've both gotten to make your mark on this practice for future generations of attorneys.
That's why we love it, right? No day is identical to the preceding day. I don't want to denigrate any other area of law, but I would think, and Paul does a lot of estate planning, I would think after you've drafted a couple hundred wills, there's kind of a sort of similarity to them. But, when it comes to the various taxes that we deal with, basically it's just always something new and different. It's amazing how many different permutations you'll see of of these tax issues.
Now, one of the best things about our practice is the people we have. We have some wonderful people. Mark joined the group 9 years after I kind of created it. During that 9 years, we had a number of people who came and went. When he joined us, he wasn't the only one in the group with me.
I wasn't his first choice.
There were other people. He was my first choice because he had been here as a part-time clerk, and But
just for the record, I did not want to be a state lawyer. I didn't even want to be a tax lawyer.
He wanted to be a litigator.
I came out of law school and I wanted to go to law school and come out a lawyer like I see on television and in the movies, right? I want to be Clarence Darrow. I want to get in front of a jury. And I was asked by the head of the tax department, Don Lubick, if I would be willing to spend 6 months in tax because they didn't have any room for me just yet in litigation. But they promised me that by Christmas time, they would have a place and off I go. And so, as Paul said, I started part-time. I then started after Labor Day, after I passed the bar, and I worked till Christmas. And then sure enough, true to his word, Don came over and said, okay, you've worked through Christmas. Do you still want to go to litigation? And I thought, heck no. This is actually fun.
And how many cases now have you litigated or argued in front of an administrative law judge or a tribunal? I mean, it's so easy to conceptualize tax law as just, poring over tax codes and research heavy, and we're sitting with our calculators and our pocket protectors and doing the math and preparing people's tax returns, which is really not what we do at all. We do a ton of litigation.
People always ask me around April 15th or October 15th, oh, you guys must be swamped. And actually, those are slow times because most of our work comes from accountants, and they're kind of busy that time of year. So it's really strange. I think we get busiest, around the end of the year when people are planning to what they're going to do next year.
We're going to pivot here for a minute. We've been talking a lot about how rewarding it is to practice this area of law and some of your favorite cases that you've come across. But one of the things that I want to ask you about is more with an eye on the future of this area of law. You've seen New York take its residency audit program and its sales tax audit program from quite literally non-existent to incredibly robust and sophisticated and nuanced. And you've seen some other states follow suit. And Paul, I believe you had a hand in some of the agreements that actually happened between those states to make things run in a more coherent fashion between multiple states.
Well, that was the goal. I don't know if it came to fruition. Paul was involved in the NASTOA agreement, which is a group of Northeast states that all have the same kind of rules. The idea was you shouldn't be taxable by more than one state. How'd that work out, Paul?
Well, it worked out pretty well. However, New York drafted the legislation that many states would have to adopt in order to implement the change. A number of those states adopted that legislation. New York was not one of them. And so many of the states that have the legislation have it operative with any other state that also has the same reciprocity. If they're going to treat my people fairly, I'll treat your people fairly. New York wouldn't sign the law they drafted, so it didn't happen. However, there were provisions of it that have been helpful. They're rarely invoked because most people don't even know they exist, but we know about them and we utilize them when it's to the advantage of our clients. So
Do you often sit and think about, what other states are out there that don't have aggressive or active audit programs that you think to yourself, if this state really wanted to, maybe even just based on their tax rates alone, they could really become a problem for their taxpayers?
There's a reason we sent you to California to take the California bar exam. That wasn't just for fun. Well, we see a huge potential because California has, now the second highest income tax rates, second only to New York City. And of course, they're right next door to Nevada, which has a 0% income tax rate. So yeah, we see a lot of potential there. We see Connecticut has been becoming much more aggressive. And think about it, it goes back to my original comments. States go after non-residents because it's a source of income from non-voters. What's wrong with that?
Also, when we mentioned the other taxes, sales taxes and so forth, these states that don't have an income tax have to support themselves. So many of them have very aggressive sales tax programs, have very comprehensive sales tax. New York will sometimes change the sales tax by interpretation, not by the change of the law. Texas, many times every year, has some amendment to the sales tax saying, well, we didn't tax white and blue pens previously, but let's put that down because somebody just created one and that should be taxed along with everything else. So we many times get involved with other states in other kinds of taxes.
Sure. And that makes perfect sense because the funding for highways and hospitals and all of that important stuff has to come from somewhere, right? If it's not coming from a state income tax. So, gentlemen, we've talked, a lot about the past. We've talked about the present, but something that I wanted to ask each of you is when you look forward in the practice of state and local tax law, do you see any major changes on the horizon that you think might be something that taxpayers need to think about, or any real radical changes at this point? Or do you think we've hit a point of more consistency where states have been doing this for long enough that the audit programs are going to remain relatively consistent?
Yeah, I don't see that. I think it's always changing. The world is changing. If you think about the sales tax that we have on information services, the law says it applies to items including those that are multigraphed and mimeographed. That's going to change at some point because the world has changed. I don't think I've seen a mimeographed item in 20 years, 30 years. So there's always changes. And I think one of the things, Joe, nationally we're seeing is more and more states are looking to change their income tax and corporate tax to where the customer is located, not where companies have property. Historically, companies were taxed based on where they had the most property, where they had the most people, employees. So payroll was a big factor. And if you think about it, it's really counterintuitive to any kind of economic development. The more people you employ, the more we'll tax you. The more property you buy, the more we'll tax you. So most states, New York in some cases, but not for, let's say, partnerships, have gone to where we don't care where your people are. In fact, we'd love you to have more people here. We look at where your customers are located. And that helps in two ways. One, from an economic standpoint, it means that I'm not penalized for hiring more people in a state, which is a good thing. But secondly, it means that when states are taxing businesses based on where their customers are, they get to tax non-residents again. So for example, I don't know if Netflix had an office in New York, but when New York changed its rule to look at where the customers are located, a company like Netflix was never taxable in New York. And New York set up a rule back in 2015 that said, look, we no longer care where your property is. We don't care where your payroll is. But if you've got more than $1 million worth of sales to New York customers, if you're an out-of-state company, we're going to tax you. You have what they call Nexus. Well, what a great way, once again, to tax an out-of-state company, because I can assure you Netflix has more than $1 million worth of receipts from New Yorkers. So it's a way of taxing, again, non-voters, and at the same time helping your own state's economic development. That's just beginning. We're seeing that, I think, economic nexus exists in maybe 26 states so far. So we got a lot more to go, and that's changing the landscape dramatically.
Right. And just picking up on something Mark said, he said, not talking about partnerships here or LLCs. LLCs and partnerships have a completely different method. It's what corporations used to have, where you look at property, payroll, and receipts. There are cases, the Friedman case is one that comes to mind, where the taxpayers moved to Florida. Husband and wife moved to Florida. They were the partners of the partnership. They didn't come back to New York at all. They clearly were Floridians. However, they didn't move the partnership. The partnership conducted a business. The business was conducted in New York. The property, its leased property was located in New York. Payroll, which was the employees, not the location of the partners, in New York. And receipts, it sold products in New York. And so they were still taxable on 100% of their income by New York State, not by New York City. And we're shocked by that. And of course, because it was a flow-through entity, partnership, it was subject to the New York City unincorporated business tax as well. So people that went to Florida thinking we should save some taxes didn't save any taxes really at all. But another focus of the tax department has been on so-called flow-through audits because they feel that the federal government doesn't audit them very well, whether it's partnerships, LLCs, S corporations. People start out by looking at the federal tax return of an individual and look at whether they were resident or non-resident. But these flow-through audits say, wait a minute, you're a partner in a partnership. We have to look at that partnership, and we have to look at the partnerships that partnership invested in. Or you have a trust, and we have a trust that may be a resident trust, and maybe it claims not to be subject to New York taxes, but maybe it is because maybe it has some flow-through income that's New York source, things along those lines. So those kinds of things. Also, though, COVID gave us an example of how things change. So who expected that to happen? But when it did, offices shut down all over the country, all over the world. And people started working from home. Well, if you worked for a New York City employer in a high-rise building and now you were working from home in, say, Connecticut or in Maryland or in your vacation house in Florida, was that still New York work? Were you still subject to New York payroll taxes and so forth for working in New York when the New York offices were completely closed and no one was working in the New York office and you were only working out of your home in Florida because they wanted the company to continue to function, but they wanted people to work from wherever they were anywhere in the world. New York and other states got involved in that. Some of them modified their rules. There was litigation at the U.S. Supreme Court level even between Massachusetts and New Hampshire, with New Hampshire residents who normally don't pay income taxes being subject to Massachusetts taxes for working at home in New Hampshire for a Massachusetts company during the pandemic. Those kinds of things develop, and even if they were an issue in the past, they become more of an issue. And we get involved in helping people with those kinds of problems. So what we know is that things will change. New areas of taxation will exist. Questions will arise.
Yeah, and taxes are based on activities, right? We tax sales tax on certain activities, income tax based on where activities are. And as the world continues to evolve, things go, electronically, digitization of everything, the laws change and the rules change. Or if they don't change, the interpretations, as Paul said, will change. So when we said mimeographed, we really meant sent digitally as well. Even though they said it back in 1965. So as the world changes and people change and business locations change, sales tax is changing, income tax is changing, all of the SALT world changes. So I don't see any shortage of work for the foreseeable future, and I think it's going to continue to be very interesting work.
Well, thank you both very much for your time. Folks, you heard it here first, or maybe you've heard it before, but the world of state and local taxation is ever-changing. It's nuanced. It is niche still to a certain extent, but the attorneys here at Hodgson Russ are experts at what we do. We have a lot of experience in this field, and as you heard today from two of the founding fathers of the state and local tax practice group.
Grandfathers.
No, he's the older guy. No, I'm still a kid.
There's so much that is encompassed in this fascinating area of law. Gentlemen, once again, thank you for your time today. This was a fantastic interview, and I greatly appreciate it.
It's our pleasure. Thanks for having us.
Thanks, Joe.
Thanks for joining us for another episode of State Tax Talks. If you're interested in listening to more episodes, we're available on all platforms where podcasts can be found, including YouTube. If you enjoyed this episode of State Tax Talks with Joe Tantillo, please give us a 5-star review on your favorite podcast platform. And if you're in need of a tax professional, you can contact the tax attorneys at Hodgson Russ. Go to www.hodgsonruss.com for more information. And until next time, I'm Joe Tantillo, and this is State Tax Talks. Catch you later, tax fans.